Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at the top 3 dividend paying companies from the number 1 sector to buy now, according to Kevin O'Leary. The investor from Shark Tank, he's well respected in the financial industry. He's the chairman of O'Shares ETF, and he has a net worth of over $400 million. And this famous investor has laid out the number 1 sector he believes is a buy now for many different reasons. In a recent interview with Kitco News, this is what he had to say when he described the healthcare sector to be a great buy at this current point in time, and let's take a listen.
But there's also a momentum within governments, particularly the US government, to repatriate all aspects of healthcare. That means bringing back generic drugs to Puerto Rico, to Canada, to stateside, to Mexico, so that they're very close to the population and we don't get stuck where we don't have medical devices or PPP materials in the next pandemic. Because I don't know when COVID-20 is coming or where it's coming from, but I know it's going to come eventually, and we have to be set up for that. So the billions of dollars that will be invested in healthcare is a very good theme.
So according to Kevin, the future developments and the growing government spending into the healthcare sector makes it a great industry to own in your personal portfolio. And later on in the interview, he mentioned that he's already fully weight in the sector, and the healthcare holdings make up around 20% of his total equity portfolio. So Mr. Wonderful, Kevin O'Leary, laid out a few points to why he believes the overall healthcare sector will continue to grow over the next few years with increased government spending. So in this video, we're going to break down 3 companies who may benefit from this future development, domesticating the different government and healthcare resources into the United States and the surrounding nations. And these are the brands who are already leaders in their healthcare sector and are expected to continue to dominate for long into the future. And all 3 companies pay out a growing dividend every single year. And we're going to take a look at their current operations, a little bit about their financials, and their dividend and dividend safety. But before we can jump into that first healthcare company, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and of course today, we're going to focus on the healthcare sector because that's the industry that Kevin O'Leary believes is a great buy right now for increased government spending and future developments over the next few years. And stock number 1 that we're going to take a look at in a little bit of detail is ticker J&J, which is Johnson & Johnson. They have been one of the strongest healthcare companies in the world over the past few decades. They currently trade for $169 per share and are up by over 15% on the 1-year chart. J&J has a current market value of $445 billion. They trade with a very reasonable forward PE of only 17.7 and a current dividend yield of 2.5%. And overall, I believe Johnson & Johnson, with their diversified product mix that continues to expand year over year, their growing revenue stream from all around the world, I think this company will continue to be a main player in the healthcare sector for long into the future. And if we take a look at their recent performance, in Q1 2021, they generated over $22 billion of sales in a 3-month span. And that grew close to 8% year over year, which is absolutely phenomenal for such a large company. And Johnson & Johnson is so creditworthy, they are rated as AAA, and they are one of 2 companies who actually has a higher credit rating than the US government. The other is Microsoft. So for a company in the healthcare sector, like J&J, to be so highly regarded in the credit industry, to be one of the only 2 companies ranked higher than the US government, that's extremely impressive and shows how safe and stable Johnson & Johnson really is. Their diluted EPS grew 7% year over the past quarter as well, and they operate in 3 main product categories: worldwide consumer health sales, pharmaceutical sales, and medical device sales. And combined, all 3 categories allow J&J to be a leader in almost every single industry under the healthcare sector. And taking a look at their numbers, over the past 20 years, this has been one of the strongest companies in the world. They grow sales at an average of 6% year over year, and their earnings have been growing at 8% annually over the past 20 years. They've increased in their dividend payment 59 consecutive years, making them a dividend king, and their average shareholder return over the past decade is at 13.1% per year, which is absolutely phenomenal. And the company's total free cash flow continues to grow even higher every single year as well, to over $20 billion in 2020. Their EPS is trending upwards, and around 70% of their sales come from the number 1 or number 2 market share position within each category. So like I mentioned, they do own the leading products across multiple different sectors. And why I like J&J so much, and a reason I own them in my personal portfolio as well, and the fact that they're definitely a great healthcare company to do some research into, is because their total revenue is diversified across 28 brands and platforms that generate over $1 billion in annual revenue. So back in 2020, the company generated over $85 billion of total sales. And of that number, it was spread out across 28 different billion-dollar brands, all owned by J&J. So even if 1 or 2 of these products goes downhill anytime soon, the company's total sales are not going to be harshly impacted. They're not reliant on 1 or 2 key brands to drive their total growth. And that's why I love this company so much. Nicely diversified revenue across a global market, and that continues to grow. The company has 16 different products who generate over $1 billion in annual revenue, and they own 12 different brands that bring in over $2 billion in sales every single year. And now if we move on and take a look at J&J's dividend information, the current yield on the company is at 2.5%. They pay out $4.24 per share per year, and their payout ratio is extremely sustainable, coming in at 44%, so a lot of room to continue to grow that payment going forward and reduce the company's debt every single year as well. And their 5-year dividend CAGR is at just above 6%, and their dividend growth streak, like we saw on the investor presentation, is now at 59 consecutive years. And according to Simply Safe Dividends, they have the highest dividend safety score possible, coming in at a 99, meaning the dividend is extremely safe and very, very unlikely that we see a dividend cut coming from Johnson & Johnson anytime soon. And in my personal portfolio, I own 21 shares. It makes up around 3.5% of the total value, and I'm up 26.7% on my J&J position, and they pay me $89 in passive income every single year. So this is a company I own in my personal portfolio as well, one of my favorite healthcare brands that I will continue to buy for the long term. So J&J was stock number 1 in the healthcare sector, where Kevin O'Leary believes is going to see a lot of future developments in government spending over the next few years to domesticate a lot of manufacturing and product development. And now if we continue on into stock number 2, it's going to be ticker LLY, which is Eli Lilly. They trade for just under $200 per share and have grown by an insane 166% over the past 5 years. On the shorter term chart, they are up by 32% over the past 12 months as well, and the company has a market cap at $181 billion with a dividend yield at 1.7% and a current forward PE ratio right around 25. And taking a look at their numbers, similar to J&J, they had a very strong Q1 to start out 2021. Their total sales in the quarter grew 16% year over year, which is amazing, and their total volume grew 17% as well. They believe they're going to continue to generate long-term shareholder value through their new product development that's in the pipeline right now, expected to hit the market over the next 3 to 5 years. And overall, their actual productivity and their profitability improved as well, and their Q1 gross margin was 75.4%, which is absolutely incredible. For all these healthcare companies to maintain such a high gross margin, 70+%, is why they're achieving such great long-term success. And if we take a look at the company's income statement, year over year, their total sales continue to grow. 21 billion up to 22.3, 24, and then in the past year, over $25.4 billion in total revenue, which is absolutely phenomenal, and the long-term upward trend continues year after year. And taking a look at their cash flow statement, because this is a dividend-paying company and that dividend every quarter is paid out in the form of cash, as long as all these brands have growing free cash flow, like we saw with J&J, we know that dividend will likely continue to grow for many years in the future. So jumping over to Eli Lilly's cash flow statement, we can see that right now they've done a fantastic job of growing their total free cash flow over the past 4 years. Back in 2017, they had $2.5 billion of total free cash flow, up to 3.4, 4.4, and now $5.5 billion of free cash flow in the past year, which is absolutely phenomenal. So their dividend has a lot of room to continue to be paid out and grown every single year as well. And taking a look at that actual scorecard, the yield comes in at 1.7%. The payout ratio, similar to Johnson & Johnson, very low and very sustainable, right around 42%, and they've been growing that payment, averaging 9.5% per year over the past 5 years. And another company that's considered very safe, coming in with a 96, and in their last dividend growth, they actually increased in their payment by 15%. And Eli Lilly has a low beta of only 0.56, so you can buy into a company, collect some nice growing passive income that's not very volatile on the market, and that dividend is expected to be very safe over the short and medium term. So this was the second healthcare company. They're more of a pharmaceutical name as well, who manufactures and develops different drugs all around the world. And now as the government wants to domesticate these facilities, I think that will lead to increased spending and increased initiatives for Eli Lilly, really helping the company's bottom line. So this was stock number 2 in the healthcare sector. I do not have a position in this company just yet, but they are on my watch list for maybe a new addition to the healthcare sector on any dips we see in the market going forward. And now as we transition into the third and final company we're going to take a look at in this episode, it's going to be ticker UNH, which is United Health Group. They trade for $411 per share and have grown by 35% over the trailing 12 months. And over the longer term, if we take a look at the 5-year chart, UNH has been a very steady performer, growing by 207% overall, and they trade with the current forward PE of only 22.2, and their market cap sits at $388 billion with a dividend yield of only 1.2%. So UNH, definitely another major player in the healthcare insurance market as well, that's seen growing results year over year. Taking a look at the income statement, they generate a ton of revenue every single year, and it's almost impressive to even look at these numbers. Back in 2016, $184 billion of total sales in that year. Every single year, the number continues to grow, which is absolutely amazing, to over $262 billion of total revenue in the trailing 12 months, with no signs of slowing down. And taking a look at the bottom line, their profitability improves every single year as well, with over $16 billion of net income in the trailing 12 months. And similar to J&J and Eli Lilly, growing free cash flow is a very important metric to take a look at when evaluating a dividend growth company. And we can see on UNH cash flow statement, the net income grows at the top every single year, and their cash flow growth has been nothing less than spectacular. $11.5 billion back in 2016, up to $13 billion, 16, 20, and now over $23 billion of free cash flow, and they've more than doubled it. From back in 2016, $11.5 billion to over 23, the company's more than doubled their free cash flow in only a 5-year span, which is absolutely phenomenal. And if we take a look at that dividend, although the starting yield is the lowest out of all 3 companies at only 1.2%, their payout ratio is the lowest as well, making up only 27% of their net income. So it's extremely safe, a very low payout ratio, a lot of room to improve the business and grow that payment going forward. And they've actually been increasing your annual dividend at an amazing rate year over year as well, averaging over 20% dividend growth per year for the past 5 years, which is absolutely incredible. So although your starting yield may be lower, that compounding effect is working much faster than the other 2 companies, averaging over 20% annual dividend growth is amazing to say from a healthcare giant. And we can see, similar to J&J, the highest dividend safety score possible, coming in at a 99, so very unrisky, a very safe company, no dividend cut expected anytime soon, and their last dividend increase was by 16%. So overall, UNH operates more in the insurance side as well of the healthcare industry, But if you take a look at Johnson & Johnson, Eli Lilly, and United Health Group, you'll get diversified exposure to different manufacturers, different insurance companies, different distributors that operate all around the world in the healthcare sector, where Kevin O'Leary believes there's a ton of potential to see long-term capital appreciation while collecting some growing passive income into your portfolio every quarter as well. So that is the number one sector that Mr. Wonderful believes is a great buy right now. He himself is fully weighted in the industry, and it makes up around 20% of his personal portfolio. So definitely some companies to take a look at, do some research into, speak with a qualified professional before you make any investment decisions. I appreciate you watching to the end, and I will see you in tomorrow's video.